Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Tariff hike. President Trump doubles steel and aluminium duties to 50% following his pledge to support domestic manufacturers. The increase coming into effect in just moments from now. Holding up, new data shows resilience in the U.S. jobs market, easing concerns President Trump's tariff war is pushing the economy into a downturn. Asian stocks rising for the first time in 4 days. And capping the chaos, South Korean assets getting a boost from Lee Jae-Myung's election as president, with voters seeking change after months of political turmoil. The Kospi on track to hit a bull market. It has just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai, setting up for a long couple of days off. We have Eid coming up, so this is our last show for the week, but of course, not the last show for markets, with a lot of attention on the data that's been printing this week. JOLTS data yesterday surprising to the upside in the U.S. with those job openings coming in higher than expectations. And that, of course, is a precursor ahead of non-farm payrolls coming out on Friday as well. So more and more data to watch out for. The result, though, yesterday was that Wall Street ended once again in the green. S&P getting close to 6,000 again. You can see futures this morning not doing a whole lot. We're down about 0.1%, but still getting close to that 6,000 level as the market also digests the fact that President Trump once again has raised tariffs on steel and aluminium. We will talk more about that. They are set to come into effect. Those higher tariff rates of 50% are set to come into effect as of now. So 50% on steel and aluminium tariff imports, imports into the U.S. at a 50% rate. And NASDAQ futures today also slipping down about 0.1%, though we did see a better end to the session yesterday. NVIDIA, one of the outperforming stocks, up 3% in trading. We have Euro also in focus this week, so trading sideways, but of course a big ECB meeting coming up on Thursday. The expectation is that the European Central Bank will cut rates again by 25 basis points, though attention will also be on the latest economic projections on both inflation and growth likely to be revised down. Then take a look at aluminium. This is the primary contract. Today, prices are up 0.4%. And over the course of the year, it has been a bit of a bumpy ride, but actually trending higher just in the last couple of sessions. And we'll talk more about specific commodities, metals, the mining outlook with the guests we have at 8:30 this morning. All right, for now, let's check in on how markets in Asia are faring. Avril Hong is in our Singapore studio, and the handover from Asian markets seems to be mostly positive today, Avril.
Yeah, even with these tariffs going into effect, I think what investors are more focused on is the resilience being seen in the U.S. jobs market and this idea of an easing in tariff tension. So that's what's fueling the optimism across Asia today. We have the region's benchmark, as you mentioned a short while ago, snapping a 3-session losing streak. We have the chip stocks tracking their U.S. counterparts as this continued return of the AI trade is being seen. The South Korean gauge is in the spotlight. This is on track, I should say, for a bull market, and this is after the election results kind of removes a key overhang for the local markets. The political risk, we're seeing the stocks that are doing well today are the ones that are seen as potentially benefiting from the new president's reform agenda. The chip stocks also helping to support those gains you're seeing on the Kospi that is climbing by the most in about 2 months. I would just highlight as well what we're seeing on Korea bond futures for the 10-year, dropping to the lowest level since February, because this idea of expansionary fiscal policies from the new administration could mean more bond supply. And this is kind of coinciding on the day where a 30-year auction in Korea also saw a demand that wasn't great. So interesting to keep an eye on the long end of things in South Korea bonds as well. Jumana.
Avril, thank you so much for the overview. Now, President Trump has signed a directive doubling steel and aluminium tariffs to 50%. The higher levies coming into force just a few minutes ago. The White House says the move will help protect American jobs and domestic industries.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs. If not for this president, that steel plant in Pittsburgh, Pennsylvania would have closed. Those jobs would have been lost. And the president saved that company, he saved those jobs, and he's saving that community. And that's the intention of the steel tariffs, which he will sign later this afternoon.
Okay, let's bring in Bloomberg editor John Herskovitz. Talk us through this latest decision out of the Trump administration to increase the tariffs on steel and aluminium, and of course, risking some blowback from European allies. Europe has said that they would likely have to respond if the tariff rates were increased. They are now technically higher than they were. Talk us through the rationale.
Sure. For the Trump administration, this is about protecting jobs, about protecting the local industry. And the announcement came last week in Pennsylvania when Trump was talking about a decision regarding Nippon Steel's plans to acquire U.S. Steel. This had been a contentious issue. The Trump administration had opposed it. The Biden administration had also opposed it. But Trump changed tack and said that the investment could go forward, but with certain conditions, that U.S. Steel remains U.S. controlled, U.S. operated, that there would be protection of jobs, and there would be investment in steel infrastructure, bringing the plants, making them a bit more modern. This is not what Nippon Steel had in mind when it made its acquisition bid. The details of the plans are still being worked out. We don't know what's in all of this, but this is. The tariffs were laid out at that time, the increase in tariffs laid out at the time as part of the Nippon Steel deal. And it also came at a very difficult time when Trump's been facing decisions in a federal trade court, questioning some of his so-called reciprocal tariffs on specific countries as being beyond his authority. That decision's been stayed as it's being reviewed for an appeal. But that's been the overall view of what's going on with the aluminum and steel tariffs.
Yeah, so these sectoral tariffs still remain not in that specific remit that the courts were potentially raising as illegal. I also want to ask you about some of the comments that Treasury Secretary Scott Bessent made yesterday in Switzerland. He was saying that Beijing has a choice on whether or not it wants to be a dependable partner with the rest of the world, and keeps reiterating this point that he would like to see China move towards a more consumption-led economy. How is that likely to resonate with Chinese authorities as we speak about potential phone call between President Trump and Xi Jinping?
Yeah, I don't think that what Secretary Bessent had to say is really going to sit well with Chinese authorities. They have accused the U.S. of failing to live up to the agreement that they made between the two of them for their bilateral trade dispute. And the two nations, the U.S. and China, have been going back and forth about making accusations about who is doing what in terms of enforcing or not living up to the deal. So we had Chinese Foreign Minister Wang Yi met the new U.S. ambassador to Beijing and complained about the U.S. in the way that it's confronting the trade dispute. And this also comes against the backdrop of what the corporate Chinese firms have been doing. Bloomberg had a report about how they've been preparing for these trade disputes, how they've decreased reliance on the U.S., offshoring, increased R&D, and tried to make themselves less reliant on the U.S. market for their profits. So corporate China learned from the Trump administration the first time around that they should be prepared for another round of trade difficulties. And according to the Bloomberg report, a lot of them have prepared and are not getting as much exposure to the trade friction as they were during the first Trump administration.
Bloomberg's John Herskovitz, thank you so much for the reporting. Now, Elon Musk has blasted President Trump's signature tax bill as a budget-busting abomination as Republican fiscal hawks step up criticism of the package. The bill is expected to cut federal revenue by about $4 trillion over a decade, adding about $2.5 trillion to the federal deficit. Musk's attack comes days after he left his temporary post leading government cost-cutting for the Trump administration. And U.S. job openings unexpectedly rose in April in a fairly broad advance, while hiring picked up, indicating demand for workers remains healthy. Meanwhile, Fed officials are repeating their wait-and-see mantra as President Trump continues to negotiate tariffs with U.S. trading partners.
These were the last reports coming in before the tariffs. So now they're just question marks. Is that going to, are the tariffs going to have a small impact? Or are the tariffs going to have a large impact? And now we're just kind of, we gotta wait and see.
Joining us now is Mahjabeen Zaman, head of FX research at ANZ. So another day we walk in, another tariff headline, this time specifically on steel and aluminium tariffs. They've been hiked to 50%. As an FX investor, are you still responding to these latest tariff headlines and tariff announcements out of the Trump administration? Or is it a case of what everyone's talking about, taco, just waiting for the Trump administration to back down?
Exactly right. I think what we are watching now, and market is also the way market has been moving in FX, it's really now starting to move more to the cyclical drivers out of the data that's coming out of the US, as we saw last night, rather than these developments on the tariff front. I think the key dates in July and August that are coming up at the end of the end of the trade truce or the tariff truce, I think that's really the key event that we're looking and waiting to see. In the meantime, I think all eyes on the data. Of course, there has been a view that there is going to be slower growth in the US on the back of these tariffs. But, so far, the jobs data is still holding up. I think it will take some time for that data to start reflecting on the downside into Q3 and Q4.
Yeah. There was a while a couple of weeks ago, and especially after Liberation Day, where the market started talking a lot more about recession, the probability of recession. But since then, since the 90-day pause, what we have started to see is positive sentiment come back. And even some of the recent data has surprised to the upside in the U.S. Yesterday, we talked about jolts and the job openings also surprising to the upside. Do you think there perhaps is too much market bearishness on the outlook for U.S. growth here?
Not really. I think the data is quite mixed, as you rightly said, but there are some early indicators which are pointing to a little bit of softness there. Of course, jobs data this week will be important, but when we look at continuing claims, which is, people looking for claims because they're unable to find jobs week after week in the US, that seems to be rising. So that's an early indicator of the job market. Savings rate we saw is also starting to move up. So people are now becoming pretty cautious around spending. And of course, I think the biggest point here is long end rates. And, if they continue to shift higher, we think about the home building side and the mortgage rates and the housing sector, that's going to be impacted.
Okay, so that's a long-end rate scenario. But what about what this fiscal or this tax package might mean for the U.S. economy? Surely a fiscal boost is pro-growth in the second half of this year, or actually leading into 2026.
Look, I think it's hard to say how the additional spending will convert into more growth, especially because when we think about the tax cuts, look, the tax cuts are a continuation of what we already have. It's not extra additional money in household, individuals' pockets. And so I think from a consumption perspective, that's not going to add much at the margin. And then, of course, we think about other structural drivers of this fiscal agenda. Clearly, with more issuance down the road, we got to think about the marginal buy of treasuries. Look, I think with foreign interests likely to now decrease given the tariffs that are coming into play, who's going to be that buyer and what's that going to mean for yields? So again, I think likely that's going to weigh on yields and probably see higher yields there, which in this case would likely be negative for the dollar.
Yeah. Okay, let's talk about the euro, given we have a big European Central Bank meeting coming up tomorrow. I just wonder also whether euro is trading as a function of what the ECB may do, or simply in retaliation to the weakness in the greenback. How do you think euro will look coming the other side of this ECB meeting? I.e., what are your expectations for an ECB meeting? Are we going to get a more hawkish ECB or a dovish ECB?
Look, probably going to see a little bit of a dovish ECB there. Inflation is pretty much in line. Real wages are in line. Services inflation, which tends to be sticky, also coming off. So all of that points to more easing down the road. Of course, what's coming up this week is largely priced in. We expect another 25 basis points easing in Q3. However, when we think about the euro, a lot of the optimism around the euro side, whether it's more easing, which is great for households, or whether we look at the fiscal agenda that's going to play out over the next few years, we think that domestic news is already factored into the euro. I mean, euro TWI is close to its all-time highs. I think the next leg higher for the euro will really come from that USD weakness side of things and how much more safe haven properties that it can offer, which is arguable where we are today, having seen the way the dollar has already moved significantly.
Yeah. Mahjabeen, always a pleasure to talk to you. Mahjabeen Zaman, head of FX research at ANZ. Thank you. Well, still ahead, as South Korean stocks rise as Lee Jae-Myung takes the presidential oath, ending a months-long political leadership vacuum. We're live to Seoul next. This is Bloomberg. South Korea's new president Lee Jae-Myung has pledged to revive economic momentum following 6 months of political chaos spurred by his predecessor's martial law declaration.
저에게 맡기신 첫 번째 사명.
For the first duty you have entrusted me with, I will make sure there is no more military coup d'etat, and the power entrusted by the people will never be used to intimidate people.
For more, let's go live to our Seoul studio and bring in the Asia Trade co-anchor Sherry Ann. Sherry, good to have you back with us. Well, this is a resolution of, I would say, 6 months of lots of tumult in the South Korean political backdrop. What can we expect in this new era? What did we learn from the new president's speech this morning?
It was 6 months of political turmoil, but what a whirlwind election it was, because I haven't even had a chance to adjust myself to calling him incoming president, to just President Lee Jae-Myung. I mean, he took office right away. The oath of office was also very simplified, no transition period. He's now in Yongsan, the presidential office, getting down to business. He has talked about restoring the livelihoods of South Korean people, the economy here. That was the key message at his speech at the National Assembly as he was sworn in. He wants to change regulation to help businesses, shift society to focus on renewable energy. So those are the top priorities for this administration. And of course, strengthening the cooperation of South Korea with the United States and Japan. And we'll be looking forward to see if what we heard from local media here in South Korea, Yonhap saying that he could be speaking to President Trump on Wednesday directly on a call, whether that could lead to some sort of resolution when it comes to trade relations. Of course, that's the key priority for this administration.
Yeah, so foreign policy, obviously key, the relationship with Trump. But let's turn to the markets. And what we have seen is just a resurgence of the South Korean won, of stock markets after the news came out. Is it fair to say that investors are now willing to put aside some of the political tumult that has transpired over the last 6 months and look ahead to what the new president is going to bring to the economy?
I mean, Jumana, you and I have talked about Korean assets really rallying ahead even of the election. I thought that perhaps we could see some sell the news phenomenon today, but that did not happen. In fact, if we finish today, the Kospi at these levels, we're talking about entering bull market territory, up more than 20% from the lows that we saw back in early April. So there seems to be a lot of conviction right now on South Korean assets. Of course, there's a short-term boost because of the end of the political turmoil, the fact that we have a leader now finally in South Korea after, 3 acting presidents in the past 6 months, but also the fact that we might get more long-term measures when it comes to corporate governance reforms. In fact, President Lee talking about wanting to help minority shareholders. Of course, we have seen that boost already being felt with a lot of people having talked about perhaps that long-standing Korea discount in South Korea to turn into a Korea premium.
Sherry, thank you so much. Great reporting the last couple of days. Sherry Ann in Seoul. Now, coming up, the IDF claims to have struck Syrian weapons after projectiles were launched towards Israeli territory. We get the details next. This is Bloomberg. The Israeli military says its fighter jets have struck targets in southern Syria after rockets were fired from Syrian territory into an area it controls in the disputed Golan Heights. Israel says it's holding the new Syrian government responsible, but the foreign ministry in Damascus says it hasn't verified the reports of rocket fires. Stuart Livingston Wallace is our executive editor for MENA in Russia. So talk us through what we know about what happened overnight in Syria.
Yes, I mean, it's very muddled is the short answer, but I think it's a reminder of a couple of things, that 2 projectiles, which appear to be rockets, go into Israel from Syria, which I think is the first time since Bashar al-Assad fell. So it's unusual in that respect, but I think it's a reminder to everyone that, you know, there is still quite widespread chaos in Syria. No one really is in charge, and there are lots and lots, I would hesitate to say dozens, but probably, of different groups all competing for power. Some of them ideological, some of them just sort of pure gangsterism. So I think that's a reminder that it's going to take some time before we get some sort of stability there.
Yeah, and of course, the interim president's office saying the ministry has denied responsibility, saying numerous parties are trying to destabilize the region to serve their own interests, so therefore extracting themselves from the projectiles that were launched. I want to take you to a different topic based on an article that our colleagues wrote yesterday. And that is about some countries in Europe, the UK, Netherlands, and France, saying that they have considered applying trade sanctions, even withholding arms sales to Israel on back of the latest intensification of military operations in Gaza and the ongoing humanitarian situation. How serious are these threats, and what does it tell us about the Israeli Prime Minister's standing amongst European leaders now?
Yeah, I mean, his standing is quite poor, and I think they've sort of tried the diplomatic route for some time, and have been enormously frustrated that, if anything, things have got worse, not better. And I think you've sort of heard similar echoes of that from the US as well, by the way. But in terms of Europe, I mean, this is not a complete change of stance. You know, it is an escalation from their side, but, you know, we're not about to have a cut-off of trade or arms supplies or so on, or it doesn't appear to be. But I think they've all come to the realization that there is a heavy political price to be paid for their stance to date. And you've seen, for instance, the great example is Macron, the French president. Now, his standing in the polls, or in terms of public opinion, has gone up significantly since he changed his stance on Gaza. And so I think there's a lesson there for all of them that, you know, how much longer are they going to have uninterrupted trade, arms supplies, and vocal support for what is going on there? There will be a price that they will all have to pay for doing that. So they're trying to find a middle ground, I think. But no, I don't think anyone is suggesting that they're about to completely reverse course.
And even their calls for Palestinian statehood, is that likely to be heeded?
Yeah, I mean, again, I think France is sort of leading the charge on that. And we know Saudi Arabia is involved. There's going to be a summit at some point this month. Whether that makes any headway is difficult to see. I mean, again, it comes back to the basic problems of where exactly is the state going to be and who's going to lead it. You know, there's some real problems there.
Stuart, thank you so much. Stuart Livingstone-Wallace, our executive editor for MENA and Russia. And when we come back, we're going to be talking more about those steel and aluminium tariffs with Morgan Stanley commodities analyst. We'll be right back. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Tariff hike. President Trump doubles steel and aluminium duties to 50% following his pledge to support domestic manufacturers. The increase took effect at the top of this hour, but the UK has been exempted as trade talks continue. Holding up, new data shows resilience in the U.S. jobs market. Easing concerns, President Trump's tariff war is pushing the economy into a downturn. Asian stocks rising for the first time in 4 days. And capping the chaos, South Korean assets getting a boost from Lee Jae-Myung's election as president, with voters seeking change after months of political turmoil. The Kospi is on track to hit a bull market. It has just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Another positive end for Wall Street yesterday, keeping a close eye on the data that's been hitting this week. JOLTS data, job openings surprising to the upside, suggesting that the labor market is relatively resilient despite everything that we talk about around the uncertainty of tariffs and so forth. And of course, the big one this week is going to be non-farm payrolls on Friday as well for more signals for the U.S. economy. Today, though, we have S&P futures trading sideways just below 6,000, so getting close to that 6,000 level. Once again, it's been quite the recovery since April, with S&P up around 20%. NASDAQ today also not doing a whole lot, but yesterday saw a good rebound led by NVIDIA. those shares were up more than 3% in trading. Energy also having a good couple of days in response to the price action in spot. Euro, you can see trading just below 114. We've got the ECB meeting coming up tomorrow. 25 basis points of rate cuts priced in. The focus, as we were speaking about earlier with our guests, is going to be on those inflation and growth forecasts likely to be downgraded. So that could have implications for future monetary policy decisions and the path forward. And then also taking a close look at aluminium markets this morning. These are the LME exchange contracts, so marginally up 0.6%. But the Midwest contracts, which are the ones more exposed to the latest round of steel and aluminium tariffs, spiked up quite significantly on Monday and Tuesday. So we're going to talk more about the price action in commodities in just a moment. But for now, let's also check in on how markets in Asia are faring. Avril Hong is in our Singapore studio, and the handover is pretty positive today.
It is indeed, Joanna. I mean, we're seeing the region's benchmark snapping a 3-session losing streak, and this is against the backdrop of optimism about the further easing of tariff tensions, even though we're seeing these levies on metals taking effect. It's also about this resilience we're seeing in the U.S. jobs market, so that's filtering through into the session across the region. The chip stocks are the ones that are doing well on the region's benchmark, tracking their U.S. counterparts. It's this return continuing of the AI trade. Not doing so well today, though, is the stock of Toyota Industries. This is, of course, a company that is part of the Toyota Group, and it's received a buyout offer of $33 billion from the group, which is seen as severely undervaluing the company. That 12+% drop you're seeing is the steepest since August last year, which is the time of the yen carry trade unwind. And we're actually seeing it as the biggest cap or the biggest decliner, capping the gains on the region's benchmark. South Korea's Kospi, just quickly highlighting as well, on track for a bull market. And of course, it is that post-election euphoria. The stocks doing well are those that are seen as benefiting from the new president's reform agenda, though the bond futures on the 10-year, those are the ones that are coming under real pressure today. Joanna?
Avril, thank you so much. Avril Hong in Singapore. Let's go back to the top story today, though. President Trump has signed a directive doubling steel and aluminium tariffs to 50%, with the higher levies coming into force just half an hour ago. The UK has been exempted from the hike as trade talks continue. And lucky for us, we have an expert joining us now on the show to talk us through the implications. Amy Gower, metals and mining commodities strategist at Morgan Stanley. Amy, really good day to have you on. Talk us through how you're thinking about the impact these tariffs will have on both aluminium and iron ore, which, of course, is a key component that goes into steel.
Yeah, thanks. And thanks for having me on the show. So, look, I think when we look at aluminium, the key way this is likely to be expressed is in the Midwest premium contract in the US, which is the duty paid component of aluminium priced in America. So what we've seen already is quite a sharp move up in that contract, and that probably continues. So the US is highly dependent on imports of aluminium, and that's probably not going to change anytime soon. And so that metal will still need to be coming in for now under that higher tariff regime. I think what we're seeing in the short term is that these tariffs have probably not been fully reflected in the Midwest premium price yet. And this is because short term, we probably still have material that came in before the 25% tariff and then material that came in under the 25% tariff. So you don't necessarily get a full reaction on day one. You might also have some demand impact. So as you mentioned, the UK has this exemption only at that lower level. And so consumers, end users might be waiting to see if there are more exemptions as well. But over time, we would expect this to be reflected.
Okay, so potentially more premium to be priced into those Midwest contracts. You also said something that I think is quite interesting, and that the U.S. is very reliant on these imports. In your research note, you talk about it being 80% reliant on aluminium imports. So I'm guessing, putting on my economist hat, there's no option for these companies either. They have two options. Either they have to pay the higher premium and absorb the costs, or pass it on to final consumers. It's not easy for them to find alternative markets, you're saying.
Yeah, so a couple of weeks ago, we actually heard about the construction of a new aluminium smelter that is planned in the US, but that won't be online until 2030, even if that process begins immediately of planning and constructing that smelter. So in the short term, it's quite difficult to build out that capacity. There are other avenues. So the US, for example, is quite a big scrap metal exporter, so they could potentially do more domestic processing. Again, building out that capacity takes time, but that would also be a path to reduce dependence on imports.
So you talk about the potential for the Midwest pricing to continue moving higher, or for their more premium to be reflected in the pricing. But at the same time, you also speak about China aluminium production hitting an all-time high. Why is that not being reflected in where the price of aluminium is trading?
So China has this capacity cap in place. So if we look back over the last 15 years, China has supplied pretty much all of the global aluminium supply growth. But they've always had this capacity cap in place where they said at about 45 million tons, we won't be adding any more capacity. And we think this is the year where China's bumping up against that capacity cap. So although China is producing at record levels, it's probably peaking or close to peaking. And so actually we're going to start not having that incremental growth from China. And then what we've seen as a result of all of that supply is not much investment actually in aluminium smelting capacity elsewhere. And so hence we still have quite a tight market.
So aluminium is one of the, again, key metals that goes into the construction of solar panels. I just want to ask you about your broad outlook for some of those key energy transition metals, the likes of aluminium, copper as well. How are you seeing the momentum in that part of the market more medium term, especially as many countries around the world are reviewing some of their energy transition incentives?
Yeah, absolutely. So I think when we look at these new energy demand drivers, the way I would frame it is China has really been the growth engine for most of these metals in terms of demand growth over the last decade or more. And as we look forward, these newer uses become the growth driver. So it's not necessarily that they're supporting all of the demand, but they're driving that incremental uplift. Now, as you mentioned, some countries are pulling back. What we're seeing at the moment is still very, very strong momentum in China. So very, very strong solar installations year to date, very, very strong grid spend, perhaps offset slightly by slower momentum elsewhere. But I have to say what's going on in China is probably still more of the driver on this energy transition story in terms of driving those metals demand.
Amy, thank you so much. A great day to have you on. Thank you for explaining to our audience the different drivers of aluminium and, of course, copper as well. Amy Gower, metals and mining commodity strategist at Morgan Stanley. Well, the World Bank is committing $1 billion to help the Democratic Republic of Congo prepare for what could be the world's biggest hydropower project. The bank will initially commit $250 million towards the scheme, which aims to bring electricity to 300 million Africans by 2030. For more, Bloomberg's Indira Ganga joins us now. Indira, what do we know about Inga 3 and its potential for power generation?
Hi, Jumana. So this is a project with so much potential. At its full capacity, it will be twice the size of the Gorges Dam in China that produces up to 22,500 megawatts. The Inga Phase 3 will be able to produce up to 40,000 megawatts. And this is able to feed into up to 40% of the electricity demand on the African continent. Currently, Phase 1 and Phase 2 produce under 2,000 megawatts. And all of this electricity goes into mining companies across the country. So what we're seeing the World Bank trying to do is a programmatic approach. You're marking 250,000 in the first phase of this project. And what they're going to do is to try and spur economic development in the area, engage local communities, but also attract foreign investment, because this is a big project. Granted, it can produce up to 11,000 megawatts of electricity, but they need up to $10 billion. You need to attract investors. But then again, it's going to be an uphill task because Congo has challenges, and many investors and governments do not trust the Congolese government due to misappropriation of assets, corruption, and changes in political regimes.
And is that why there has been a dearth of these type of projects to date, because of some of the issues that you just cite now? I'm just wondering why projects like this haven't taken off already.
Jumana, there are several complex layers to this. If you're asking somebody to earmark $10 billion, what you're asking them is to trust your leader, to trust your policy environment, and to also trust the strategic direction that you're going. Unfortunately, Congo does not have that luxury. Also, a project of this magnitude, you're generating so much electricity. Congo can not only use all this electricity, but also it cannot pay. And so you're looking at countries like South Africa, you're looking at Angola, you're looking at Nigeria. And South Africa had expressed interest in being the off-taker of this project. But then again, that was 2007 to 2010. Congo's government is so unreliable. And so South Africa had to find alternative sources of using this energy. And also it's an amalgamation of contradiction. Only 20% of their population have electricity, to mean 80 million people are living in darkness, despite the potential of this country being able to generate up to 100,000 megawatts if they capitalize on all their resources. And that's where the World Bank is coming in, saying we're going to try and inject transparency. We're going to try and foster reforms in the state-owned body that's responsible for production, generation, and distribution, and ensure that this project not only benefits the elites that are putting money in, but also the locals.
Bloomberg's Ondiroganga in Kigali, Rwanda. Thank you so much for that reporting. Now for a look at some of the other stories we're following today. South Africa's High Court has dismissed a lawsuit to stop the government from raising fuel levies. The higher charges were proposed last month by Finance Minister Ina Gorengawa in his third attempt to get an annual budget through Parliament. The lawsuit filed by the Economic Freedom Fighters Party argued that raising fuel costs would hurt the poor South Africans and undermine growth. A new report says Kenya serves as a transit hub for smuggled gold from other African countries, including South Sudan and the Democratic Republic of Congo. The Swiss aid investigation found illicit outflows from Kenya probably exceed 2 tons per year, but only 672 kilograms were declared in 2023. The report says most gold smuggled out of Kenya is shipped to Dubai, with other destinations including India and South Africa. Volkswagen is considering car production in Egypt as part of plans to tap new African markets as it grapples with weaker demand at home. Europe's largest car maker says it could first establish an assembly unit using existing facilities, then build a local factory. VW is cutting production capacity and jobs in Germany due to increasing costs, weaker European markets, and the rise of cheaper Chinese competitors. Zimbabwe will allow 50 elephants to be killed in a key conservation area as part of efforts to manage a growing population. Authorities have issued permits for what they call an elephant management exercise. An aerial survey conducted last year established a population of 2,550 animals, which is more than 3 times the area's capacity. And coming up, Turkey posts a surprise inflation slowdown, fanning hopes of an interest rates cut. We'll discuss the easing path outlook next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Well, just crossing the Bloomberg terminal, a Turkish court has formally arrested 22 suspects after a police operation, according to reports from the state-run Anadolu agency. Now, those arrested include main opposition mayors of 3 Istanbul districts. Mayors of 2 Adana districts have also been reportedly arrested. So we're going to keep a close eye on developments there. Now, speaking of Turkey, the country's inflation eased last month to the lowest since November 2021, potentially paving the way for an interest rate cut. So let's bring in Turkey economist for Bloomberg Economics, Selva Bahar Baziki. Good to have you with us. So let's talk about those inflation prints. Actually surprising to the downside. Do we expect this disinflationary process to continue after quite a lot of turbulence in the last month?
Morning, Jumana. A large movement down in the inflation rate was already expected even before the print. We were expecting the inflation rate to dip below 36 already. And that was because of a large and favorable base effect coming from a large leap in inflation last year by about 5 percentage points to above 75. May 2024. Now, with that base effect fading out, however, we already expect annual gains to accelerate for June. That doesn't mean that it's going to be derailing the general deceleration that we expect in inflation further out. The easing path ahead remains intact. In fact, we see the downside surprise backing our call for a year-end print of 28%, and that's lower than the current market expectation of 30%. A final point on whether the central bank's 24% outlook is attainable. Based on the current oil price outlook and also exchange rate expectations on surveys, we don't think that that's a very high likelihood. Actually, we assign a probability of around 10% of that materializing.
Yeah. And Selva, back in March, we saw a weakening of the Turkish lira in response to political developments. And because of that, the central bank actually had to hike interest rates by 350 basis points in its April meeting. Given the inflation picture now looks like it's going in the right direction, does that set the stage for the central bank to once again resume its interest rate cutting operations?
Definitely so. We don't think that the downside surprise is actually going to motivate a shift in the general expectation that we were seeing the central bank likely to resume rate cuts later in the summer already. And that's not just motivated by the deceleration in inflation, but also a weakening in the outlook for growth. So slower growth prospects are likely ahead, as well as budding labor market trouble. So those two factors, those two non-inflationary factors, had already had a bearing on the central bank's earlier easing, both in terms of the timing of its steps and also the size of its steps. So going forward, the three factors together, including inflation, are all pointing towards further easing coming from the central bank. Now, whether that's going to look like a rate cut to the policy rate or just a streamline or a simplification of the central bank's funding mechanism, which now remains split between its policy rate and other funding windows, that will be determined by what's happening with its reserves and the lira. Following the March 19 lira rout, as you said, the central bank bled out a large sum out of its foreign currency reserves. Rebuilding that will also remain a priority. So that's going to suggest that the steps coming will be slow and small in size.
Yeah. A Turkey economist for Bloomberg Economics, Selva Bahar-Riziki, thank you so much. And coming up, it's already been a roller coaster year for private capital firms. Next, we're live at the industry's biggest forum, SuperReturn in Berlin. This is Bloomberg. Well, private credit has positioned itself as a safe haven, but a tumultuous start to 2025 is seeing that narrative put to the test. Deals have dried up and stocks have tumbled in response to global trade disruptions. Though, of course, many of those stock market indices are now back to where they were. Lots of volatility. As tensions escalate, leaders in private capital are gathering at SuperReturn Berlin, the industry's biggest forum. Bloomberg's Kriti Gupta is there. Kriti, well, private credit, private equity, so much interest in that space. How is the mood right now at the forum? What are some of the themes being discussed this year?
Well, Jumana, this is a really fascinating time for private markets because for a lot of the kind of last few years, in the face of volatility, in the face of geopolitical risk, private markets were a place to kind of hide your money, keep it safe, and really capitalize on it. The problem here is that was on the assumption that 2025 would be this big year of capital markets reopening around the world. So you would see IPOs, you would see deals, you would see massive issuance in the credit markets, and you haven't actually seen that because post this kind of tariff agenda from the Trump administration, this increased volatility that you're seeing has actually chilled that effect, that optimism that you're seeing. On top of that, a lot of big firms around the world, including major endowments in the United States, like Harvard or Yale, for example, talking about liquidating some of those private markets. So some of the juiciest pieces of the financial markets that were supposed to have their moment in the sun in 2025 may not, because they're faced with volatility and that deal glut. And that's the conversation we're going to have here at SuperReturn about how to navigate those dynamics.
Yeah, and one of the other dynamics is investment opportunities in the U.S. As we speak about the potential end of U.S. exceptionalism, how is that translating into appetite to invest in the U.S.?
Well, it's fascinating because the juiciest deals in private equity, you ask anyone, in private credit and private markets and infrastructure, aren't in the U.S. at all and haven't been for quite some time. They're actually right here in Europe and arguably right here in Germany, where there's so much infrastructure spend coming down the pike, specifically that 500 billion euros worth coming from Friedrich Merz and his potential coalition in Germany. Now, this is crucial because it's creating such an opening for defense, for infrastructure, for AI when it comes to these private markets. And you have to be able to operate in scale. And that's where these markets are eyeing here. They're saying, look, the opportunity isn't in the U.S. at all. It's in Europe. And that might be the case for the next few years.
Kriti Gupta in Berlin. Really looking forward to your interviews and coverage over the next couple of days. That was Kriti Gupta at SuperReturn. All right, a quick look at markets. Before we head out, just a reminder to viewers, we're actually going to be off air the next couple of days for the Eid holiday. So we will be out, but markets, of course, will continue to trade globally. Some big data coming up the rest of this week. On Friday, we've got non-farm payrolls. Tomorrow, the big European Central Bank decision as well to watch out for. This is where futures are tracking right now. S&P down about 0.8%. NASDAQ 100 down about 0.8%, even though, broadly speaking, these markets continue to do quite well. European markets up 0.2%. The big news of the day, extra tariffs on steel and aluminium imports into the U.S. But that was it for Horizons Middle East and Africa. I'm Jumana Versace in Dubai.